Okay, week 5 of Sally's dog walking business, and week 5 represents the last week that we're going to be recording transactions for Sally's business. And you've been doing great so far, and I think that you're probably a bit of a rock star by now, so we're going to dial up the complexity a little bit, move things a little bit faster, and introduce some new concepts in terms of financial transactions. So strap yourself in, let's have some fun. Okay. Starting off with a nice easy transaction number 21. So Sally, with the way things are ramping up for her, she recognised that, well, I've only got $25 of inventory in stock for dog food, and if my sales are anything like last week, I'm going to need some more, so I better start to order big. So she does. She goes to her supplier and says, listen, I want to get $200 worth of inventory this time, and the supplier gets a little nervous by that, although Sally was good on her earlier transaction of paying the $100 off. He doesn't want to give the $200 on a complete IOU, so he says, I'm going to need some cash up front for that. And Sally says, well, I've only got $94 in cash. I can give you that, but if you can extend me 106 IOU, that'd be great. And of course, he's good for that because he gave her $100 before and she came good on that. So he's okay to extend $106 IOU this time. So why don't you go ahead and enter that transaction of buying the inventory. Okay, so obviously here we're getting $200 of inventory. So this one's going to go up by $200. We'll do that one first, $225. And we paid $94 in cash, so our cash goes to zero. And at accounts payable, we've got $106 IOU, so accounts payable goes up by $106. All right, assets are $690, equity and liability also $690, so we're in balance. Let's move on to number 22. This one is a bit of a doozy. Okay, you might need to replay this section a few times, but let's see how we go. So this is basically looking at, it's an operations type transaction. We've got businesses picking up. We've got $350 in walking sales, $150 in food sales. With that food sales comes $100 in food costs, and the total of $500 in sales that we've made, 500 being 350 plus 150, that $500 comes in the form of $400 cash and $100 as an IOU or accounts receivable. And we're also hiring our sister for more hours this week. We're going to double the amount of hours we're hiring her for, so the labor cost is $200 and we're going to pay her in cash. So you've got a number of entries here to adjust. You're going to have a cash adjustment, you're going to have an accounts receivable adjustment, you're going to have an inventory adjustment, and you're going to have a net income adjustment. So I'll give you a crack at doing that one. Okay, so I'm going to start on the cash side of things. So let's take a look. What we've got coming in is $400 in cash coming in, and we've got $200 in cash going out. No cash changes hands for the food costs because we've already got the inventory there, so we don't have to spend any money on that. So 400 minus 200 equals 200 up in cash. So cash is going to go up by 200. And let's do our accounts receivable. That's the $100 IOU. That goes up by 100. So it's going to be 225. And while we're on the asset side of things, let's make our inventory adjustment, and that is $100 in food costs. So that's going to go to 125, down by $100. Okay, so that's all the current assets taken care of. The property, plant, and equipment, nothing to do over there. So I think we're done on this side of the ledger. Liabilities, we didn't buy anything, and we didn't owe anyone anything. Nothing's happened to our bank loan, so it's just the net income side of things that we need to adjust. So let's take a look at that. Well, if we were to do the cheats version, we could see that our assets are $890 and our equity plus liability is $690, so the difference is $200 there. So I'm guessing that the net income needs to be $200, but let's just check that. So we've got $500 in sales, and we've got $200 in costs, in direct costs, in labor costs, and $100 in food costs. So total of $300 in costs against $500 in revenue. That gives us $200 of net income. So that should be $200 in there. Okay, $890 for assets and $890 for equities plus liability. We're in balance. Happy days. Let's take a look at transaction number 23. So, because we're getting more and more dogs, Sally's a little nervous that the people down at the local park are going to start to get upset with the amount of dogs that her and her sister are bringing around. So she decides to go to one of her friends who has a pretty big backyard and a lot of space, and says, look, would you mind if I rent your backyard off you for $50 a week? And then she's got a contained space to take the dogs. Everyone's going to be happy. Friend's happy to do that. Makes a bit of extra income on her backyard. And the other thing that Sally recognises is that her sister's out there quite often with these dogs, and if something goes wrong, her sister has no way to get hold of her to call for help or to let her know if she might need any help. So she decides to get a mobile phone for her sister, and that's going to be at a cost of $15 a week. So let's go ahead and enter these two transactions of rent and mobile phone of a total of $65 a week for week 5. Okay, so the transaction here is pretty much one between cash and net income, and both are going to go down by $65. So this is going to go to $135. And this is going to go down to $135. And that is going to complete that transaction. So we've got $825 in assets. We've got $825 in equity and liabilities. We're in balance. Happy days. Let's move on. To bring some context to where we're at, we're going to take a look at now our income statement. And we're also going to record a new transaction on this one. So we're going to start by just entering the transactions that have happened to date for week 5, and they're over here on the side. Okay, we've got the sales, we've got the costs, we've got the rent and the mobile phone. Because you can see that I've got I've put some of these new expenses under the expense part of the income statement, not under the cost of goods sold. So why don't you go ahead and ignore for now transaction 24. Let's just enter in where we are to date on week 5. Go ahead and do that. Okay, so let's walk you through that one. So walking sales, 350. Feeding, 150. Our labor cost was 200. Our food cost was $100. Okay, so gross profit was $200. Now rent was $50. Mobile phone was $15. So that's it. So if we look at this so far, before we enter transaction 24, we've got $500 in sales, $300 in cost of goods sold, our gross profit $200, and then our fixed expenses of rent and mobile phone. Total expense of $65 leaves our net income of $135. Now for transaction 24, we're going to take a look at the concept of depreciation. So we're going to do this in context of buying a cart. You see, Sally's sister is finding that dragging around the dog food, the toys, the pooper scooper, all this sort of stuff is a lot of work when she's got quite a few dogs. So a little cart that she could load all the stuff into would make things very helpful and make her more efficient. So Sally thinks that's a good idea. So they're going to buy a cart for $120 in cash. And because with plant, property and equipment, that is things that generally last a long time. So for the government stipulates that you can't just take that $120 you're going to pay for your cart and write it all off or claim that as an expense in 1 week, because that would lower your income dramatically. If we just put that $120 in cash, that cash expense in week 5, it would bring our net income right down to like $15. And because you pay tax on your net income, your tax would be a lot less. So the government says, listen, you're going to have that cart for, I'm going to say, at least 2 years. So therefore, you can depreciate it over 2 years. So what that means is that every period, you get to claim a little bit of that expense as an expense. And we're going to say that we're going to depreciate it over 24 months, which is 2 years. That equals, we call it straight line depreciation. If you divide 120 by 24, you get $5 a month. So every month we get to claim $5 as an expense on that cart to depreciate it. Now I've made it a little complicated because we are dealing in weeks here, and I'm saying we're depreciating months. So we're just going to enter it in 1 week, and this is the last week we're doing it, so it won't mess us up too much. But what we're going to do is we're going to enter that depreciation there as $5, and then we're going to flip over to the balance sheet and have a look at how that transaction shows up on the balance sheet. So we can see there our expense is now $70, net income is $130, now that we've claimed that $5 of depreciation. So let's take a look at transaction number 24, the cart, on the balance sheet. And look, I'll let you have a go at this one. It's a little tricky, but why don't you have a go and then I'll walk you through it. Okay, let's see how you did there. So we bought the cart for $120 in cash. So immediately we know that cash goes down by 120. So that goes down to 15. Then just like all the other times, now we're in plant, property and equipment. We've got a cart line here. So we've got to enter a value here. Now, with all the other entries we've done, the leashes, the pooper scoopers, the dog toys, we've just entered in that same value. But this time, we've incurred some depreciation. We've already claimed $5 in depreciation. So what that means is, as far as the balance sheet is concerned, that $120 cart is now only worth $115. That's $120 minus the $5. So we enter $115 in there. And that means that that $5 of depreciation, remember, we entered that as a cost and it decreased our net income. So therefore our net income goes down to $130. So therefore assets is $120, equities and liabilities $120. And if we go back to the income statement and compare our net income lines, so net income here is $130, net income back here is also $130. So we're in balance there also. So that's a little tricky. In future months, each time we claim the $5 in depreciation, the cart will continue to go down by $5 here, and net income will go down by the corresponding amount. And eventually, you know, very close to the 2-year mark, after we had the cart for nearly 2 years, this will be right down to like $5. And that's when they talk about depreciating or writing things down. That's what they mean. The value goes down because it's worth less. And that's how we account for it from an accounting point of view. Okay, moving on to transaction number 25. Now, unfortunately, the best of intentions of some of Sally's customers didn't come to fruition, and some people that she had extended credit to, they actually moved away. They moved out of the neighborhood and they just forgot to pay Sally. And Sally hadn't done a great job of, you know, being very assertive on following up on the debt. She just figured that people would be good for it. So unfortunately, she's incurred a bad debt of $50. So I'll let you have a go at this one. Okay, now this one's a little tricky also. Incurred a bad debt of $50. Now the way this shows up is that we didn't lose any cash because we never had the cash. It's the accounts receivable that goes down. The people that owed us $50 are no longer going to owe us $50 because they're no longer around. We don't know where they are. So therefore, we've got to take that down by 50. Goes to 175. And we account for that. Right now, we're out of balance, 770 versus 820. We account for that as an expense. and an expense will take down a net income. So net income goes down by that same $50. So that's going to be $80 on the net income. So now we have 770 and 770. We are in balance. Moving on to transaction number 26, Sally's sister is getting a little cheeky and says, hey, I've been working pretty hard here. You're making all this money. Look at all this revenue and income you're making. I'd like a pay rise. Now, Sally's a bit squeezed here because she really needs a sister to help out and feels that like she's really got to give in to that. So she does. She gives her the 5% increase in wages, which equals $10 a week. So I'll let you go ahead and enter this one. Okay, so to make that entry, we have to pay her in cash. So our cash goes down by $10, and our net income also goes down by $10. Okay, so looking at our assets, 760 on the asset side, equity and liability 760. We are in balance. Transaction number 27. After Sally's experience with the customer leaving and not paying, she decides that I got to get a little savvy here and I got to follow up on some of these accounts. So she does. She puts some calls into her customers, and sure enough, after putting some calls in, she collects some accounts receivable. In fact, she collects $110. So I'll let you go ahead and have a go at entering this transaction. Okay, so accounts receivable, we collect $110. That's good for cash. So cash goes up by 110. So it's going to go to 115. And accounts receivable goes down by 110. So that's going to go down to $65. So now we've got the assets at 760, equity and liabilities at 760, so we're in balance. So nothing happened on this side of the ledger, right? Net income didn't change. All we did was went out and got what was owed to us. So just a change in the current asset portion of the balance sheet. Okay, transaction 28. Time to pay off our supplier. Again, Sally wants to keep on good terms here so the supplier is going to feel safe to continue to lend her money. So we're going to take some of that cash we've got and pay off our accounts payable. Off you go. Okay, so pretty straightforward. We're going to pay off the accounts payable, so that's going to be $0. And it's going to take our cash down to $9. Alright, so total assets $654, equity plus liabilities $654. Pretty straightforward transaction. We're in balance. Let's move on to transaction number 29, which is our last transaction. Now, pretty simple one. We're going to incur $2 of interest on the bank loan. So you'll see lending from the bank is often not as good as lending from family. Our interest rate has doubled. But anyway, we needed the money to run our business, so it's fair enough. We should pay that interest. And if we don't, the bank's going to ask for their money back pretty quickly. And as you can see, our cash position is not that strong, so we should make sure we don't want the bank to recall their loan. So we should pay the interest. So go ahead and enter that transaction. Okay, this one is paying $2 in cash for the interest. That goes down to $7. And interest is a expense as far as your income is concerned. So the net income goes down by $2 also. That's going to be $68 here. Now total assets $652, equity and liabilities $652. We are in balance. Okay, now week 5. Let's take a look at the income statement. We've had a few, we filled this out a little earlier, but we've had a few extra things come in since. They're all listed on the right hand side there. So why don't you have a go at entering those on your income statement and then just check that your net income at the end here coincides with the net income amount on your balance sheet as it stands. Off you go. Okay, so I mean this is putting the numbers in here. So our walking sales are 350, our feeding sales are 150, total sales 500. Labor cost was Franculo. Okay, let's see how you did there. Let's transfer these across. So walking services was 350. Our feeding sales 150. So total sales is 500. Labor costs, well, we had $200 in labor, but then we had that pay rise requested 10, so it's 210 in total. Our food cost, the dog food, was 100. So total cost of goods sold is 310. Gives us a gross profit of sales minus cost of goods sold, gross profit of 190. Now expenses, we've got rent for $50. We've got the mobile phone charge of 15. We've got depreciation of 5. We've got that bad debt that we incurred of $50. And we've got interest of $2. So our total expenses are 122. We take 122 away from 190, we're left with 68 in net income. So if we check that 68 with our net income on our balance sheet, that is correct. So we've accounted for all things there properly. So that is our income statement for week 5. Okay, well let's take a look now at how our statement of cash flows adds up. Pause. Okay, well let's take a look at how our statement of cash flows now looks at the end of week 5. So you'll see our statement of cash flows is getting a little more detailed here. We've got one new entry here of the depreciation in the operating cash flow, and that means that while we claim an expense for depreciation as far as the income statement goes, it's not really a cash expense. So we didn't actually pay $5 in cash, so we get to add that back in. That's actually good for cash. So I'll let you have a go at this one. There's a number of things to put in there in the operating cash flow and also the investing cash flow. Your financing cash flow, to give you a little tip there, that's going to remain at 0. But your check and balance, as always, is to look at your ending cash position, which is $7, and your starting cash position was 94. So to make it easy to fill this out, it's a good idea to pull out this balance sheet, go back over your notes and pull out the week 4 summary, because that's the ending balance sheet for week 4, which also marks the beginning balance sheet for week 5. That's how the business was at the start of the week. And then this one here on transaction 29 marks how the balance sheet ends up at the end of the week. So if you have those two side by side, it enables you to see the changes in accounts receivable, changes in inventory, changes in accounts payable, and so on. So you can easily make the entries there. So go ahead and have a go at filling out the statement of cash flows. Okay, so let's see how we did there. We can start with our net income. Now, net income we can get from our income statement or from our balance sheet. Both of them say $68, so we know that one there is 68. That was our net income. Changes in accounts receivable. Let's take a look. We started with $125 in accounts receivable, and we finished with $65, so that's a change of $60. Now that went down by $60. That means we collected money in. People gave us money, meaning less people owe us money, so that's good for cash. So that's positive 60. Change in account payable. Let's have a look. So accounts payable was 0. Starting balance was 0. Ending balance was 0, so there was no change in accounts payable. So no change, but you know that it did go up at one stage. At one stage it was 106, but it also went down all within the same period. So we're just looking at the starting and ending change, and that was 0. So that remains at 0 here. Add back in depreciation. I talked about that before. because we incurred that $5 expense on our net income, it wasn't really a cash expense. We didn't pay cash out. We just got to claim that $5. So we get to add that back in. That's good for cash. And changes in inventory. Let's take a look there. Inventory was $25 at the start of the period. And at the end of the period, it was $125. So that went up by $125. When inventory goes up, it's like taking cash out of your bank account and putting it on the shelves. So that's bad for cash because cash goes down. Okay, so that's negative 100. Bad for cash. So we can see there that operating cash flow, our net operating cash flow is $33. Investing cash flow, purchase of assets. We did buy that wagon for cash, so $120. Sorry, I said buy for cash. It really doesn't matter whether we paid cash or not when it comes to this. We're just looking at, did we buy any assets or sell any assets? So we did buy assets at $120. And then we look at our financing cash flow. Did we borrow or repay any money? No, we didn't. Didn't distribute any dividends. Didn't invest any money or withdraw any money. So that one remains at zero. So our net cash change in cash is $87, minus $87. We started at 94, we ended at 7. So does that balance out? Yes, our ending balance sheet says $7 in cash. So again, we can look at this and say that we developed $68 in net income. Through our management abilities, we turned that $68 into only $33. And then through the rest of our management, we managed to go down in cash by $87. So we started with 94, we ended with 7. Most people look at it and go, but I made $68 up here. How come I'm down by so much? And you can see why. When you look at it here, well, we bought $120 in assets. We invested in inventory. I mean, there's $220 in cash going out right there. So if we're not generating the cash and income, that's going to hurt. All right, last activity for week 5 is to roll up our earnings. So I'll let you go ahead and do this one. Pretty straightforward stuff for you now, I'm sure. Okay, so roll up our earnings. Our net income goes to 0. Our retained earnings go to 352. Take a look. Our assets are 652, and our equities plus liability is also 652. So we are in balance. And that is how the balance sheet looks at the end of week 5 for Sally's business. She's taken the business from being worth nothing to being worth $352 in equity. You know, she's got $652 in assets here. She does owe $300, and hence why her equity is only $352, not the full $652. So that's not bad going for Sally. But we won't stop there. We are now going to go on the next video. I'm going to analyse some of the decisions that we made through those 5 weeks and just see if we had made some decisions a little differently, what impact might that have had for Sally. And this is really looking at the management ability of a business. So we'll sign off here, and on the next video we can analyse those decisions.